Okay. All right, fantastic. Well, welcome everyone. Good afternoon. Thank you for joining us for today's ERA live session. Today we'll be providing you with an update regarding the ERA Electronic Components Industry Trends Survey. That's a tongue twister. This monthly members-only survey launched by ERA in June of 2023 focuses on valuable industry intelligence. During today's discussion, you'll hear about critical data that's been collected to date from the survey with a summarization of trends from the first half of 2024, along with an outlook for the latter half of the year. Before we get started, I would like to remind everyone to please mute your devices. But if you would like to ask a question, please utilize the chat box or the raise hand function. I'll be monitoring that. Unfortunately, our fearless CEO, Walter Tobin, isn't able to facilitate today's discussion, so I will be introducing our guest speaker, Dennis Reed. I'm delighted to have Dennis here today. And I'm sure that most of you know Dennis and have seen him speak either at other ERA live sessions or at our annual conference or at other chapter events. Dennis is a senior research analyst at Edgewater Research, which is an independent equity research provider and market intelligence company. So Dennis is going to present the most current results from the ERA Industry Trend Survey that Edgewater sends out monthly to ERA members. In case those of you who don't know what that is, the ERA Electronic Components Industry Trend Survey provides a summarized analysis of trends and insights garnered from the data of all participating ERA members. Okay, well, I've talked enough. I'm sure that you're all keen to hear directly from Dennis himself. So Dennis, I'll turn it over to you.
Thank you, Erin, and thanks everybody for joining us. It's always a pleasure to be at the Good Friends at the ERA. I'm going to start, before we get into the meat and potatoes of it, just want to start on kind of some of the nitty-gritty details. For those that aren't aware or are not filling it out, this information is admittedly as good as the participation that we get from the ERA members. To date, I'd say it's actually been impressive, so I'm not trying to lecture anybody, but more is always better. So just from a logistics standpoint, as Erin mentioned, we conduct it monthly. You'll receive the first notification emailed the first of the month. There will be two additional reminders throughout the month. And then the results for the members that are not aware are posted behind, I don't know if it's the official term, paywall, but in the member section of the ERA website. So this is literally created by us with your input for your use. So please, please, please participate. You know, a wonky thing, and unfortunately there's no way to change it. It does come from noreply@mail.client, and there's just no way we can change that. So if you haven't gotten this, either reach out and we could tell you who the point of contact is for your company, or add this email to the safe sender list. When you, sticking with the logistics, you know, this is what the email, so, you know, there's concerns on phishing and all that other stuff. This is what the actual invite or survey looks like. So it's not spam, it's not a phishing campaign. It's branded with Edgewater, which is because we built the portal, but really it's an ERA process. So, you know, just so people know kind of what it looks like to cover the mechanics. Switching from that, I'll just touch quickly on this, because I think most know you. So we are an independent research company, as Erin mentioned. We do work with some of the largest money managers in the world, but we also work with some of the largest technology companies in the world in a process that we call fundamental research. So the core of us is engaging with, the core of our product is engaging with folks like ERA members. We aggregate that and really ultimately act as kind of a voice of the supply chain or the industry. We've been at it for a while. Our reputation dates over 2 decades. Our team is north of 60 or 65 years. So we do have quite a few years seeing a couple different things. And again, you know, deeply connected, as I mentioned. So I literally spend my days on calls, Teams, Zoom, phone, conferences, really talking from sand to silicon to manufacturer to distributor, rep, EMS, and then ultimately the end buyers. We try to take a holistic view. Again, trusted research for public and private investment companies. Actually, that really helps us because, again, then we're getting a line of sight in where capital is being deployed and how that could shape opportunities. And again, we work closely with all of our industry customers shaping strategies. My background won't hammer on that. I think I've given this to Aaron. Please reach out with questions on the survey. Edgewater is an ERA member, so we're also behind the paywall ourselves, so you can find me there. So enough of the stuff that nobody came to listen to. Let's get on to the meat and the reality of it. So let's look at sales. Ultimately, actually, amazingly, we're at about a year that we've been conducting this, and once we get the July one, I think we will be fully at a year. And I think there's a couple of things, and I heard some comments as we were all sitting here about, things are slow and there's no real jobs. And I think this actually encapsulates obviously what we're seeing here. So from a monthly standpoint, the worst that we saw across the membership was September of 2023 with sales down close to 8%. And we've, hung around there through the fourth quarter. And then we started to see some semblance of a recovery once we got into April, and that continued into May. And I think that's really broadly indicative of what we'd say that the industry is seeing overall, especially here in the Americas. A couple of things, and I think interesting things to point out is when you look at that box in the red, we've got the implied volume growth. So pricing has been surprisingly stable through this type of correction, but I think it's encouraging when you're seeing an implied volume growth from March to April that's actually improved almost 3.5 percentage points, right? So we're starting to see some level of volumes recovery. Again, I think that ultimately shapes up in the environment of what we're all seeing right now. We're seeing a bottoming pattern across the industry, and we'll continue to talk about that with kind of an uneven or lumpy recovery going forward. As we move from shippings and we move to backlog, I think this is one of the most encouraging things that I've seen. So book-to-bill ratios are closer to 1. But still below 1. And for those of you that are plugged into our traditional research, whether it's IP&E, semi, or distribution, I think you'll notice a similar commentary. So a lot of comfort that we're seeing similar results across the membership that we see on kind of a broader, more global scale. But I think it's very important to note that all of a sudden we have seen bookings flip positive in April and into May. We'll see how the June data points out. If this was 1 month and we were presenting, I wouldn't have made a big deal. But 2 straight months gives me some level of encouragement that we might have turned a corner across the membership. When I think of why for the membership, I think product makeup really helps, and we'll get to this towards the end. But we're further along in terms of recovery for the IP&E space than we are in the semiconductor space. And as we all know, the reps in general are more broadly exposed to IP&E than they are in semi. So again, I think this is good confirmation that, hey, maybe the business is turning 1, 2, but if you want to dig down a little bit, and we'll get into backlog by category, et cetera, in a few, but yeah, I think it does have a little bit to do with kind of the mix of business and less reliance on the semiconductor space. As we continue with the bookings in backlog, I think a story that also continues off seeing the bookings improve. We're continuing to see pushouts and cancellations moderate. So, when you see the pull-in number, it's a net net positive 10. Okay, that's for all rounding errors, I would say pull-ins are effectively 0 right now. But again, we're seeing cancellations, we're seeing push-outs start to moderate. So when we step back from the last 2 charts in particular, I think and think about this market holistically, what we've seen, and I think what we're comfortable saying is, is probably the first quarter of the year. Maybe it bleeds in a little bit to the second quarter, but kind of this first half of the year was clearly the bottom, and mix, customer type, all those things will impact the exact timing naturally. But we feel pretty comfortable that generally the bottom occurred in the first half of the year. And we're in these signs of finding a classical quote unquote bottoming pattern. So we've seen a return in normal levels of pushouts. We've seen the cancellations already taking place. We are starting to see some cases of order pull-ins, which screams to us that customers, not for everything, certain SKUs, certain products, etc., but they've gotten a touch over their skis and a little lean. So I'm sure you guys see it. Hey, we need part number ABC123. We need it delivered tomorrow, right? It's not broad-based. It's not anything else. It's not anything that gives you a ton of backlog growth. But again, these are all signs that you see in terms of a cyclical quote unquote bottoming. And I think that's what we're seeing across our survey results here. As we move outside of the survey results, the one thing that I did want to highlight is when you think of the recovery and we look at the recovery, on a broader scale standpoint outside of the survey, this recovery has not been clear. It has not been created equal for everybody. And I think that's probably the understatement of the century right now. And this chart to me sums it up here, right? So again, what we're looking at now is just the impact that AI has had on the industry, and some of those industry data numbers, whether it's the WSTS or things like that. But what I find interesting is if you look at the compute semi-supply chain. So this is going to include companies like AMD, companies like Intel, NVIDIA, Micron, all the memory guys, the hard drive guys. Their sales ultimately peaked in late 2022, a relatively steep but kind of shallowish correction. And they returned to that high water mark actually in the third quarter of 2023. So I know I've gotten a number of questions from individuals in the industry saying, Dennis, the SIA growth showing 50%, why are we not seeing it? Here is the answer. It is compute. So unless you are levered to memory, and by memory, I mean high bandwidth memory, server memory, PC memory, or you are directly selling NVIDIA CPUs, the recovery looks a lot different in your world than it is for these guys. And to give you an example of this is just looking at the high performance analog sales. So again, similar time period in terms of when the business ultimately peaked in late 2022. Similar, time period on the downturn, but what you've noticed is the time that it takes this subsegment to return to the high watermark actually is right. And I should indicate the gray area of the forecast for using Wall Street consensus numbers. So we can debate whether or not those will prove to be right, but that's just what we're using here. If they're right, this holds true. For the high performance analog space, as you can see, why we've already returned to that high watermark for compute. When you look at the high performance analog space, we're now thinking 2Q of 25, or Wall Street's thinking 2Q of 25. So that's pushing us, from 3Q of 23. I'm sorry, 3Q of 22, we're already looking at almost a 2.5 year to recover to that same level of sales versus less than a year in the compute supply chain. But interestingly, on compute, when you strip NVIDIA out of the equation, it looks drastically different as well, right? So when I say the recovery has not been created equal for everybody, yes, AI is 100% real. I just saw on LinkedIn that AI again is going to be centered to the ERA conference in Austin next year, which is awesome. It is driving a recovery, but right now it is ultimately driving a recovery of one by and large, which is for NVIDIA. So, I think, as you guys sit back with the survey data, or you look at your own results, or you look at other industry data, wanted to provide some intelligence here to kind of break down how much of an impact NVIDIA has actually had on the numbers. And when you strip the NVIDIA impact out, you're actually not alone. It has been a slower recovery, in particular for that analog supply chain. As we move back to the survey, and again, I think there's, it won't show up here in the PC when we look at kind of the rankings, but we know that, this isn't the biggest market for the rep community. No real surprise. There hasn't been much change since I presented this slide at the national conference in Austin back in February. Military aerospace still leading the charge. Unfortunately, the world is not a very safe place right now. So I think there's pretty easy for us to understand why those markets are driving it. We have seen some improvements in mobile equipment. Automotives remain strong. Or I'm sorry, medicals remain strong. It is a touch interesting to me that automotive remains robust, and I'll walk through some industry data here. But I think that's actually encouraging and aligns with what I'll talk about on the industry data on the next slide. But yeah, that one's kind of interesting. And then again, if we look to the ones that are sluggish, appliance, consumer electronics, mobile equipment, smartphones, PCs, IT hardware, right? All those markets, we would agree wholeheartedly on a global basis still remain kind of depressed as end demand remains depressed. As we switch out of the survey and we move into some industry data, kind of a good news, bad news scenario, I would say, for the automotive marketplace here in the U.S. So and when you look at what's happened year to date, last year the total market was like 16.1 million units here in the U.S. Forecast to start the year 15.5 to roughly 16 million. So call it flat to kind of down a couple of points. Year to date, we've hovered in that kind of 15.5, 16 million unit number. So that's clearly the good news. Units are actually holding up in the face of a higher interest rate environment. I think it's also a really, really good news when you've seen the significant fallout across the EV marketplace in the West. We would estimate and continue to estimate that upwards of 20 to 30% of all EV programs slated for launch this year have either been canceled and or delayed. So again, the fact that there have been no significant changes to a unit volume, that unit volumes have tracked in line with initial forecasts despite the EV fallout, I think it is really, really encouraging. Internal combustion has made up the slack as well as as the hybrid marketplace. I would note when you think about what this means for content or electronics growth, by and large going forward, if this were to continue and we had a flattish kind of market in the US and kind of flat production globally, I still think that works for the industry. So the math that we would think backing out any puts and takes with inventory, and clearly this year there's some takes with inventory. A flattish overall production, flattish overall US market, and then you look at just kind of the content and the hybrid story, that to us still works out to be a mid-single digit type grower. So think 5 to 8%. The delta is you need some level of reacceleration with the EV marketplace to drive back into that, low double digit to mid double digit growth. So thinking again, that 10 to 15 range, we need EVs to really come back in earnest for that to transpire. But again, 5 to 8, kind of is the way we're thinking about the marketplace with kind of a status quo EV market from here. As we move from auto and we shift into the manufacturing, honestly, not much has changed since I presented this data to the audience in Austin, and really not much has changed actually since May of 2023. The U.S. from an overall manufacturing standpoint is in, by and large, call it a flat to slightly up environment. I think for those of us who are, operating the business and you look at your results year to date, I would guess it's probably not flat to up. We'd all be thrilled with that. And the delta there again is inventory, which is kind of the common theme throughout this. But again, when we think for long-term growth drivers in manufacturing, it's really unchanged, 6-8% growth. The automotive trend, or I'm sorry, the automation trend is real. Energy efficiency is real. Robotics is real. All of those marketplaces continue to grow. Near term, we just need to sort through some of the cyclicality with the inventory in the supply chain. As we move from military, I'm sorry, as we move from manufacturing and industrial into the military, last for the industry charts, this is just looking at defense, manufacturing and shipments dating back, north of 21 years in year-over-year growth. So yeah, to me, there's a couple of things here, and I know near term there's clearly, due to some of the geopolitics between Europe with Ukraine and in the Middle East, we've seen a clear, near-term lift, especially for things that are combustible, meaning bombs and munitions and items like that. But really, when you objectively look at this long term, right, we've been in a very long-term secular trend across the industry. You could peel back into some sectors and focus on the electronic space. And really, that's even outgrowing the broader marketplace, right? So, I would challenge anybody who's bored and needs some light reading to go to bed. Feel free to read through a Pentagon budget proposal, right? And you'll see that the programs are really aimed towards digitalizing our armed services. So, it's an emphasis on communication, satellite, hypersonic. So again, things that will continue to drive electronic content long term for the industry. So that's goodness for us all involved. Who knows if that's good or bad for our enemies? Hopefully, we'll never have to find out. When we move out of the industry data, from a broader Edgewater standpoint and back to the survey results. Yeah, and I said this in Austin, and I would continue to echo this to anybody. When you're engaging with customers and or suppliers principals, most suppliers or principals, if they're honest with you, they'll tell you we've got a great sense of our own inventory, I hope. They've got a very good sense of their distributors' inventory, but the moment it leaves their shipping docks or their distributor shipping docks, they have no clue what inventory looks like. And what I would tell you is, the ERA membership is probably the best. There's close to 700 boots on the ground interacting with customers. And this is a great way to have some intelligence back for your suppliers. So, two things of interest, and I've circled them kind of up at the top or boxed them in, the customer inventory level, and I'll put some numbers from our inventory report in the next slide, but that doesn't capture the customer inventory number. So again, when you see that customer inventory, it is all skewing too high, which again, I think is why we're seeing the sluggish recovery. And then secondly, we're seeing with the passive place, those remain too high. I find it interesting the semi one is viewed as adequate. I would actually disagree with that, but I do chalk that up to, our membership does skew more towards the interconnect and the passive space. So I think it's probably important to focus on those, and kind of semis is more of a nicer and informative piece, but I wouldn't make a big deal out of it. If we compare that with what we see at kind of the broad level, this is from our inventory report, and admittedly, this is much more dated than the data that we had on the previous slide, being that this is for the reported period ended at the end of March. But, a couple of things that are problematic to us. One, if you look at inventory levels relative to 2020, on a dollars basis, the total supply chain is up 62% from 2020. So, that number is still high, and people would follow up and say, well, sales are higher, prices are higher, et cetera. And I'd agree. So if you shift over and you look at the days of inventory, they're 30% above. So that in theory should normalize for pricing, should normalize for sales. So kind of any way you cut it to us, and I think most would agree with this, this shows another proof point that inventory is still elevated. So, as we look at kind of the broader supply chain in the recovery, I think inventory continues to drive it, or restrain it, maybe is the better way to put it. In this chart, with kind of 30% above COVID on a days basis, really points to that. When we shift from inventory and we look at the lead times, honestly, there's not a ton to talk about here. When you look at interconnect, when you look at passives, and you look even at semis in the 19-week range, we're effectively at quote unquote cycle time. So, we've seen a significant contraction. As we all know, lead times have cratered. They have not moved much. And I think if you would ask us, on a go forward basis, we see, a pretty minimal case for them to move from this point. I know there have been a number of semi suppliers in the supply chain of recent issuing letters, trying to drum up backlog, calling for a shortage. We would be the one, and I don't have the CapEx slide in here, but we would be the one to say that that's really largely a scare tactic. Yes, is there a chance where a 11 and a half, 12-week interconnect lead time goes to 14? Sure. But we don't see any real case where lead times will go back to where they were, and we'll see any broad level of allocation that we saw over the last several years anytime here in the near future. Moving from lead times into pricing, and I touched on this kind of earlier. Pricing throughout this cycle has been relatively benign. We did see a little bit, it's kind of bumped around, but where we are, a couple at zero, interconnect viewed as higher. The interconnect suppliers indeed did pass a price increase on January 1st. I think we captured kind of the communications of that in this survey. But when we look at semis and passives, they've broadly been flattish. And again, if you think of this versus traditional, unfortunately, the timing of the launch, we've kind of captured all down data. So hopefully, guys, we can go drum up some business and turn it around. We can measure how this performs in an upcycle. But again, I would envision if we had this in a down cycle, traditionally or historically, it would have looked a lot worse than it has so far in the results of our survey. Lastly, from the survey standpoint, looking at what our members think for the year. So, when you look back to February, we did see a moderation. As you can see in February, it was a 1 to 1.5% growth, and now we're kind of down to flattish. I think to us, and I'll flip to it on the next slide when we go through our forecast, but I think flat, kind of by and large makes sense. As we've talked throughout the whole presentation, the AI recovery has really been a rising tide rises one ship. And when we look at the other subsectors of the recovery, we do feel comfortable that we're finding a bottom, or we have found a bottom. But again, the recovery is being driven by individual program, individual suppliers, individual end markets. So we haven't found a ton of breadth in the recovery yet. So what does that all mean from our standpoint? So this is our forecast for the semiconductor industry. We actually did raise it to 12%, but that includes the memory market. So it's 12% with memory. The only increase, honestly, was taking our memory number from the 55 to 65% on continued strength in pricing. When you strip the memory side, which is actually shown in the bar chart below, we're still thinking kind of flat to up 1. So again, very much in line with what the broader ERA membership is viewing the marketplace. When you think about how that flows, first half obviously is going to be down. And then as we move into the second half, it becomes a little bit of a stability in the overall market with easier comparisons versus the second half of last year. As we move to the interconnect marketplace, no change to our forecast, which we raised exiting the first quarter. Still see kind of a 3% number for this year. Inventory to us, as I mentioned, I think is shown in the survey is viewed as cleaner in the interconnect side, or the cleanest area. So we do think we're starting to move forward, ship to consumption, and would expect, again, a slower 1 first quarter bottoming in 2Q to kind of drag that that overall year number down. But again, do see progress and expect it to move more into that 5% to 6% number for next year. As we look to the passives, we are the most conservative with passives at flat for the year. Our concern does stem from pricing, but as you can see from the ERA survey, outside of the customer inventory levels, the passives were also noted as too elevated. So again, I think another proof point to ultimately kind of reinforce our certain level of conservatism on passives relative to a recovery in the interconnect space. So to wrap up, please, 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 please participate. The number one question that I get from your local chapter leads and individual reps is, can you provide information down to my region? The beautiful thing with this survey, if we get enough participation in your region, we can cut this data with the system for your region. So please, but if we look at a region and that has one person participate, the answer is clearly no, because we're not going to out that person, nor are we going to make it competitively. So please, 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 that's the number one request I get from the membership. This is a great vehicle to do it. So please, please participate. And with that, what questions do you have? Yep.
Anyone? You can drop your question in the chat box. You can raise your hand. You can maybe feel free to unmute yourself. We'll go rogue.
Or you can email me after, that's fine too.
Mm-hmm. Here we have a question from Adam Anderson in the chat box. How are you feeling about the NVIDIA stock price?
Adam, how much do you own? No, all kidding, all kidding aside on that, what NVIDIA has done has been pretty remarkable. If you look at their business in that previous peak in I think it was 3Q22 or 4Q22, their business was like 8.5 billion in sales. It bottomed out at 5.3 in 6 months, and now as of their April quarter, it was 26 billion. So that's remarkable in and of itself, but even that is their gross margins also have improved dramatically. So, in terms of the stock, I think you could debate valuation all you want till you're blue in the face, but if you look at objectively any company with any opportunity ahead of them that is executing kind of flawlessly right now, NVIDIA probably comes to the top of mind. The caveat to that is they are 100% market share. So at some point they will see competition. We won't stay on this exponential curve. So that's obviously your risk there. Yeah, I'll kind of go through. So what do you think is driving the interconnect pricing increase? The best of our ability, it was raw materials. So it was gold, silver, copper. It was all the metals increases that drove it. In terms of EVs, that's a great question. I know a number of folks probably in the audience have held my feet to the fire in a very optimistic EV presentation at the national conference in 2022. I still actually stand by those forecasts, and in those numbers, they amount to, I think, 40 million annual number in 2035 or something like that. So the unit growth will be there. I think what is the difference will be the OEM makeup. And someone at that conference had said, who do you think wins? And we try to shield away from talking about OEMs at any ERA sponsored event or any individual suppliers, even though I went on a rant about NVIDIA. At the end of the day, there was one major company in the West and several in China that were real EV companies. And then there have been a bunch of internal combustion engine suppliers that are throwing a bunch of money at it that aren't very successful. And then we've seen a bunch of pretenders that had no competitive advantage that are all on hard times and they're going belly up. So I think, right now we are very much with EV in that rationalization period where you're seeing you need to have a competitive advantage, one. Um, and whether that's some type of intellectual property, whether that's the ability to manufacture cheaply, quickly, you name it. Um, the ones that don't have that will continue to struggle. And you'll continue to see some fallout at the OEM standpoint, but again, I think the long-term trend continues.
Then you've got a couple of questions about the election year,
Yeah.
Michael. Yeah, if election year, do we see factoring into or too early? And then David asked, with a polarizing election looming, do you see this impacting OEM confidence in the markets?
Um, I'm always hesitant to speculate on election impact. And the number one impact, or the second question I get to that, which may come up, is, well, what happens if there's a change from the Biden administration, the Trump administration? What do you think that means for the market? I think in general, what you will see as you relate to the election is it will just be a distraction. Um, so you'll probably see some level of productivity declines, whether that's people taking longer to answer emails or anything else. But I think big picture, I don't think it changes. The election year doesn't change anything. There are some puts and takes you could make if Trump were to win. You can make an argument that some of the EV subsidies would wind down and there might be pressures there. But the counter to that would be Trump would also, wind back regulations from the Biden administration, which would fund for future investments, et cetera, et cetera. So I think in general, um, the speculation and talk around the elections, in my experience, has never really materialized in anything significant. And we would kind of bucket this year, even with the polarization and I think candidly, most in the country don't want either candidate. So we're kind of stuck with what we're stuck with, and I don't think it'll have a big impact either way.
Um, yeah.
Nearshoring question. So what's the view on moving away from China, manufacturing, bringing back some to North America? Great question, Jim. Hasn't really changed big picture, and I think I said this in past ones. I think real tangible results from this will be measured in decades, not in years. So when you think um, since China has entered the WTO, which I think was 2004-ish, if my memory serves me right, there has been over $8 trillion in aggregate of foreign direct investment. That doesn't include what China has invested themselves in the country. And in that time period, we have seen really China becoming the manufacturing hub of everything, including beyond electronics, right? Um, I think there is a need, and I think most companies have realized that there is a need to at least have some type of optionality in their supply chain, whether that's leveraging, broader Southeast Asia, Vietnam, Malaysia, places like that, or moving it back to North America with Mexico. Those are all viable options, but really the question to me becomes they all come with a cost, right? So when I engage with a number of people that would be customers, and they in particular go through, you know, the Taiwan China plus one strategy, right? We don't want any of our suppliers in China or Taiwan. If you look for a semiconductor company in general, if your front end wafers run through TSM, let's say in Taiwan, there's not much you could do with that. But let's say you package in China, you can move that tomorrow with a 400 to 500% cost increase. So yeah, we'll see ultimately when you measure that cost equation how much it impacts, but I do think you'll see people add resiliency long term. Great question from Bruce on BYD. So BYD is going to open a factory in Mexico. From what we've gathered, the target price will be $10,000 US hybrids and $15,000 fully electric vehicles. On a personal note, if they're selling hybrids at 10 grand a piece and they've got a 3-seat SUV, I'll take 2 of them right now. Be done with it. But and if they crap out in a couple of years, that's fine. They're cheaper than a $50,000 car, so I'm good with that. But all kidding aside, when we had that EV question, I referenced companies that have competitive advantages, and whether theirs are natural or unnatural, meaning government support, they are clearly operating in a much lower cost. So I think this does spell a problem for Western OEMs from an EV standpoint in emerging markets. I don't know if BYD will have success in the US. I think the US will tariff it to the point where it's completely unsuccessful and not cost advantageous. But there's not much they could do in Mexico. There's not much they could do in Brazil and other countries. So I think, when you look at several of these OEMs trying to build out lower price EV models to go into these markets, your bar for how much you've got to lower the price has gotten significantly lower if those estimates on the costs are right. So I think, when it goes back to that, we stand by that 35 million unit number. The OEM shakeup and makeup is going to be a lot different. BYD is clearly at the heart of that, Bruce.
Anyone else?
I'm going to say anyone?
Well, you have Dennis's ear. No.
No, I think so. I don't think so. Well, thank you very much, Aaron.
Well, thank you, Dennis. It's always wonderful to hear your insights. I appreciate you spending your time with us today. And just FYI to everybody, this session was recorded. A link to the recording will be posted on the ERA website at era.org under the online tools tab. So you're encouraged to rewatch it or share it with your colleagues. The date of our next ERA live session will be Tuesday, August 20th. Walter Tobin, along with a panel of ERA members, will discuss preparations and share their best tips and tricks for navigating Electronica 2024, which is the world's leading electronics trade fair, which will be hosted in Munich in November 12th through the 15th. ERA National will have a booth there at the expo to help spread the word regarding the benefits of the REP model. So we'll see you on August 20th. Until then, thank you, everyone. Thank you, Dennis.
Thank you very much, Aaron. Thanks, everybody, for joining us.
All right. Have fun
Thank you,
golfing, Dennis.
Thank you.
All right.
you.
Take
Very nice.
care,
Thank you.
everybody. Bye.